Hi there, my name's Don Foster and I'm from Strategy First Financial Planning. Today we just want to take you through some of the changes that are coming up shortly to do with the assessment of superannuation income streams, account-based pensions, for various government benefits. And these changes could potentially affect many retirees. Before we get into the changes, just want to take a moment to look at what Centrelink, or how Centrelink assesses retirees. So once a person reaches age pension age, which at the moment is age 65, they can apply for the age pension and they'll be assessed under two separate tests, an income test and an assets test. These tests are done concurrently, and the test that provides the lower age pension entitlement is the one that will apply. Now, if the client's assets or their income is over a certain lower threshold, the age pension entitlements will gradually reduce over time until their assets or income is above a certain upper threshold, in which case they're no longer entitled to the age pension. In this situation though, they may still be entitled to the Commonwealth Seniors Health Card. The Commonwealth Seniors Health Card is available to self-funded retirees, and it's only subject to an income test. There is no assets test. However, if the client's income is above the threshold, they are not entitled to it. So this one, you either have it or you don't. There's no phasing in the income test for the Commonwealth Seniors Health Card. So at a conceptual level, Centrelink for retirees is not difficult. However, where the complexity comes in is in how different assets are assessed under these tests, and particularly the income test. So for example, bank term deposits or shares held in a client's individual name will be assessed differently than property. And both of those will be assessed differently from superannuation. And superannuation in accumulation phase is assessed differently than accumulation in pension phase under the age pension income test. Add to that, the income test for the age pension is different from the income test for the Commonwealth Seniors Health Card. And both of those are different from your taxable income. So the complexity comes in how different assets and income are assessed under these tests. And today what we're talking about is some changes that are coming in association with the income test for both the age pension and the Commonwealth Seniors Health Card. Before we go into what the changes are, how is income assessed under these arrangements currently? Well, for the age pension, if you're talking about a superannuation income stream like an account-based pension, then only the amount above the deductible amount is assessable under the income test. So where a client is drawing pension payments from their account-based pension, unless they're significantly high, it's unlikely that a lot of those payments are going to be assessable under the income test because of this deductible amount. I haven't got time to go into the deductible amount today, but essentially it's treated as a return of the client's original capital over their life expectancy. And it leads to a very concessional treatment for superannuation account-based pensions under the age pension income test. And in some cases, none of the account-based pension payments are included if the deductible amount is higher than the drawdowns. In the case of the Commonwealth Seniors Health Card, it's even easier at the moment. None of the income from account-based pensions is included in adjusted taxable income for the Commonwealth Seniors Health Card. Because this person will have reached age pension age 65, and if they're drawing an account-based pension, none of those payments are included in the client's tax return. They're tax-free to the individual, and therefore none of it is currently included in adjusted taxable income for the Commonwealth Seniors Health Card. So what's going to change? Well, from the 1st of January 2015, any new account-based pensions will be subject to the deeming rules for both the age pension and the Commonwealth Seniors Health Card. I'll come to deeming in just a moment, but essentially it means that there will be a calculation done of what the income is going to be from account-based pensions, and that calculated amount is going to be included in the income assessment for both the age pension and Commonwealth Seniors Health Card. And suffice to say that for the age pension, it's likely to lead to a significantly higher level of assessable income under the income test. In the case of the Commonwealth Seniors Health Card, it will definitely lead to a higher level of assessable income because at the moment, none of that account-based pension income is included in adjusted taxable income. So let's just have a look for a moment at what deeming is. Certain assets, for example term deposits that are held in an individual's name, it's not the actual income that these investments earn that is treated as income under the income test for the age pension. A calculation is done based on a deeming threshold and the deeming rates. So for a single person, the deeming threshold is $48,000. The first $48,000 of financial assets is deemed to earn 2% at the moment, and anything above that is deemed to earn 3.5%. For a couple, the threshold is slightly higher. Their combined assets of $79,600 is deemed to earn 2%. Anything above this is deemed to earn 3.5%. So that means it doesn't matter what the investment is actually earning, these rates will be what is applied for the income test. So in the case of a single person with say $500,000 of assessable assets, the deemed income will be $16,780. The case for a couple, $500,000 of assessable or deemed assets, $16,306. And this amount is included in the income test regardless of what the investment actually earns. Now these deeming rates of 2% and 3.5% are regularly reviewed by the Department of Human Services, and they roughly reflect what somebody could expect to receive out in the marketplace for investments such as term deposits. And the thing to note is at the moment these rates are almost at historic lows. So the 2%, the 3.5%, in the last 10 years there's only been one period where they've been lower, and that was immediately after the global financial crisis in March 2009. They were at 2% and 3%. But for most of the history, and certainly in the last 10 years, for most of the time, the 2% and 3.5% have been significantly higher. Before the global financial crisis, the deeming rates were 4% and 6%. So we can see that the amount of assessable income can change depending on what the deeming rates are. So let's have a look at an example and see how the rules can potentially affect a retiree. In this example, we're going to look at John and Mary. John's age 68, Mary's age 67. They're married and they own their own home. And their assessable assets include personal effects like their home contents and a car of $20,000. Now that's just the resale value of those investments, not the insured value, which is how Centrelink assesses them. Plus they've got money in the bank, which they've got put in Mary's name at $50,000, and John's got superannuation of $500,000. Plus, to supplement their retirement income, John's doing some consulting work and earning $15,000 per annum. And let's imagine that we start an account-based pension with John's superannuation and draw the minimum amount of 5% or $25,000. How are they going to be assessed under the old rules and the new rules? So the second column here has got the existing rules of how this couple would be assessed for the age pension. The third column is how they will be assessed under new rules if the account-based pension commences after the 1st of January, or if they lose the grandfathering, which I'll come to in a moment. Well, under the assets test there's no change. They're both assessable for $570,000 under both the old and the new. But under the income test, the new deeming rules for the superannuation means that their assessable income more than doubles for the age pension income test. The reason for that is in the $16,000 under the current assessable income, none of John's superannuation account-based pension income is included in that $16,000. And the reason for that is that John's deductible amount is higher than $25,000. So all of the drawings that they're drawing from their account-based pension at $25,000 is assessed to be a return of the original capital. Under the new rules, however, the $500,000 is going to be added to the $50,000, and all of that is going to be deemed under the 2% and 3.5%. And that leads to a significantly higher assessable income under the income test. So what does that mean? Well, it means that their age pension entitlements would reduce. At the moment, John and Mary are assessable under the assets test. That's the test that gives the lower age pension entitlement. However, because of the excess income under the deeming rules, the income test will now give a lower age pension entitlement, and they would receive a lower age pension of approximately $1,780 per annum. So you can see how if the client is assessed under the new rules, they will be worse off. But that's based on current deeming rates of 2% and 3.5%. As I mentioned, these rates are at almost historic lows. So what happens when interest rates eventually rise at some stage in the future? The Department of Human Services assesses that, and if they increase the deeming rates, what's going to happen to John and Mary's pension? Well, let's look at and assume that the deeming rates rise by 1%. So instead of 2% and 3.5%, they're now 3% and 4.5%. And the effect on John and Mary's age pension is even worse. They're now more than $4,500 worse off than if they were assessed under the existing rules. And all that's happened is that interest rates have risen. John and Mary's circumstances haven't changed at all. They've still got the same assets, they're still drawing the same amount on their account-based pension. But because interest rates have gone up, which has led to deeming rates going up, their age pension entitlements could potentially go down significantly. And that's because an extra $5,500 is added to their assessable income under the deeming rules. So I've talked about this grandfathering. What do we mean when we refer to that? Well, anybody who has an existing account-based pension may be entitled to have that assessed under the existing rules under certain conditions. And what are those conditions? Well, essentially the client has to meet three conditions to get the benefit of the grandfathering on their existing account-based pensions. So for the age pension, firstly they must be receiving a Commonwealth income support payment as at the 31st of December 2014. They must continue to be eligible to receive a Commonwealth income support payment, and they must be, and the existing account-based pension must continue to be paid. For the Commonwealth Seniors Health Card, similarly, they must have received that card, applied for it, and have it be entitled to it as at the 31st of December 2014. They must continue to be entitled to that card, and the existing account-based pension must continue to be paid. So there's 2 points to note here. Firstly, under the first dot point in both those scenarios, if the client has reached age pension age and has not yet applied for one of these entitlements, but they may be entitled to it, it's important that they apply now. Unless they have received the age pension or the Commonwealth Seniors Health Card as at the 31st of December, they won't be entitled to the grandfathering for their existing arrangements, which means even their existing account-based pensions will be assessed under the new rules. But secondly, if their existing arrangements are not optimal for them, then if they restructure those arrangements after the 31st of December, in most cases what that means is commuting the existing account-based pension and recommencing a new one. And what that means is that the third point will not be met. If you stop an existing account-based pension and recommence a new one, then you won't be entitled to the grandfathering on the new account-based pension. So this grandfathering is really important for clients to review their situation and make sure that they're taking the best arrangements into the grandfathering period. So what do clients need to do? Well, if they are on receiving a Part H pension or Department of Veterans Affairs pension, or if they're entitled to the Commonwealth Seniors Health Card before the 31st of December, then we believe they should review their circumstances and make sure that they're taking the best arrangement into the grandfathering period. And what sort of circumstances might not be the best? Well, for example, if they're over age 65 and they've still got superannuation in accumulation phase, the accumulation benefits don't get the benefit of the grandfathering that account-based pensions do. Or if they're in an account-based pension arrangement from a financial institution that has high fees. And if they want to amend that, it means commuting the existing account-based pension and moving it to a new one. We're actually doing work for a number of clients in these two areas right now to make sure that they are moving into the new arrangements with the best possible financial setup that they can have. Another one, if they've got non-superannuation assets that they may be able to contribute into superannuation and commence an account-based pension, meaning they can meet the work test. Or if they don't have a reversionary pension in place and that would be suitable for them, say they've got a spouse. Now, a reversionary pension essentially means that when the account-based pension is commenced, you can start it as a non-reversionary or a reversionary pension. A reversionary pension means that you have nominated the person that it will revert to in the event of your death, usually a spouse. So in the case of John and Mary's situation, if John commenced his account-based pension as a reversionary pension, nominating Mary as the reversionary pensioner, then in the event of John's death, the account-based pension automatically reverts to Mary. And why is that important? Because it's not deemed to be a commencement of a new account-based pension, and therefore Mary gets the benefit of the grandfathering in those situations. If it was just under a death benefit nomination and not a reversionary pension, in the event of John's death, Mary is entitled to the benefits, Mary commences a new account-based pension, but it is deemed to be the commencement of a new pension arrangement, and therefore it doesn't get the benefit of the grandfathering, and therefore Mary's age pension entitlements will be reduced. So everybody's circumstances are different, and there's no rule of thumb with this. It really is, how are the individual circumstances set up, and are they the best to take into the grandfathering period? Because if they're not, what clients are going to be faced with after the 1st of January 2015 is a choice. If they take an arrangement into the grandfathering period and it's not the best arrangement for them, then they'll be faced with the choice of keeping the arrangement that isn't the best for them just to keep the grandfathering, or commuting it and starting a new arrangement that may be better for them but losing the grandfathering in the process. So in both of those scenarios there's a downside, but there's a short window of opportunity between now and the end of this calendar year where clients can actually get the benefit of both. If they look at their arrangements and deem that there is a better arrangement for them, then they can do that before the 31st of December and take the best possible position into the grandfathering period, and then they have the benefit of maximising their entitlements after the 31st of December this year. So that's what we want to give you an example of as to how this new change can potentially impact retiree clients. If you'd like further information about this, or if any client wants more information, please feel free to contact us at Strategy First, and we'd be more than happy to talk you through and take you through individual client situations. Thanks very much.